tonight's agenda, like I say, it's called How I Started Paying Attention to Stocks. Okay, that's a bit nice. So tonight, of course, obviously we're going to be talking about what actually is stock CFD trading. Let me show myself. Hey, here I am. Hello. So yes, we're going to be talking about what actually a stock CFD trading actually is. We're going to talk about the advantages and disadvantages of trading stock CFDs as opposed to actually stocks or buying stocks. Then we'll talk about the benefits or the differences between trading stock CFDs and Forex CFDs. We'll then go into a few areas which will help you when you're trading stocks, so how to evaluate stocks value or how to ascertain if there's a share which is potentially has potential. Then we'll go a little bit into, does technical analysis actually work for stocks? Because obviously a lot of people say technical analysis works for currencies and Forex and commodities. So we're going to go over some examples to see if it works for stocks as well. Then we'll do the question and answer session and of course up and coming educational events for October. So what is actually a stock CFD? Now, CFD, first of all, CFD stands for Contract for Difference. CFD trading allows you to open a position on a price of an asset without having to actually purchase the underlying asset. So instead of actually having to physically buy something and wait for it to move in value or down in value, you speculate on a potential direction that asset is going. Because that's the whole advantage of CFD as opposed to the obviously physical purchasing. So the stock CFDs actually allows you to trade a stock or a share of a company without having to actually purchase the actual share in that company. As well as that, and this is another massive advantage, and again, we'll talk about advantages and disadvantages in a minute. Excuse me. As well as that, stock CFD trading also allows you to potentially profit from a bearish market as well as a bullish market. That sounds very nice, James, but what does that mean? Well, basically that means it potentially allows you to potentially profit if a stock is falling in value as well. It's called shorting, as well as it's going up in value, called long. Now, here's some of the advantages and disadvantages between purchasing the physical stock and trading stock CFDs. Now, here's an example. Say Amazon, this is what Amazon was trading at yesterday when I was doing this example. Amazon is trading at, say, $1,911.68 per share. To purchase 10 shares in Amazon, you would have to invest, to buy it physically, $19,116.80. With CFD trading, however, to trade 10 shares of Amazon trading at $1,911.68, with CFDs you're using leverage. Say you use a leverage of 1.5, you would only have to invest $3,838.94. Now, I'm telling a story. So say, for example, Amazon rises in value, so it's a really good day. They've released some new stuff, just part of the story. Having a cracking day in the market. And Amazon prices rise to $1,995 per share, meaning your physical investment is now worth $19,950, which means you have a physical profit of $833.20. With CFD trading, because it's leveraged, your potential profit, if Amazon had risen to $1,995 per share, would be potentially $8,332. On the flip side, say Amazon actually dropped, instead of going up, dropped down to $1,828.96, your physical investment would now be worth $18,282.96, meaning you will be down $833.20. but you still have your investment of $18,282. On CFD trading, if this happened, your position would close and you would lose your entire amount you put at risk, which was $3,838.94. So you would lose all of that. So those two examples, there's the advantages of leverage, of course, potentially greater profit, but on the flip side, also at the same time, potentially greater loss. Don't forget, when you're also buying physical shares, you still have to pay a commission to purchase those shares. And when you're trading CFDs, okay, you would still obviously have to pay a commission of some sort, i.e. the spread, which usually would mean that when you open your CFD position, you start off straight away in a negative. But like I say, with physical purchase, your shares can only potentially benefit if the value goes up. However, as a CFD trader, you can only potentially benefit if the price falls, as long as you open a short position. So those are the advantages and disadvantages of both purchasing a physical stock and trading the stock as a CFD. Now, let's look at the differences between, say, a stock CFD and a Forex CFD, and again, do the advantages and disadvantages between the two. Now, stocks are only available to be traded during the hours of the stock exchanges traded on, i.e., for example, Microsoft and Apple will open up when the United States open. Forex, however, as we all know, is a 24-hour market and it's opened from Monday to Friday, so you can trade it 24 hours a day, no matter what. Of course, I'm talking about the majors. Some exotics, of course, have trading hours, but the major pairs can be traded 24 hours a day, Monday to Friday. Leverage with stocks is 1 to 5. With Forex, currently, is 1 to 30. With stocks, there is less factors to consider when you're trading them, as in there's less things to take into account when you're doing your analysis. I mean, for example, and of course we'll go over this in a later segment of the webinar. For example, you will look at a company's debt level, earnings, new products, market sentiment. Forex, there's a lot more factors to take into account because, for example, you would have to look into the performance of a country's economy, or as is versus another country, and two countries' economy. You would have to look at economic indicators, i.e. unemployment, GDP, inflation. You also have to bear in mind geopolitical events, global economy, technical indicators, media stories, what the media is talking about, what's the main headline, what's the discussion on a certain currency or certain political events. Politics is a big thing, as currencies as well, and of course market sentiment. So there's a lot more things to take into account when you're looking at Forex. Now, here's the main thing, of course, when it comes to, like everything, like with currency trading, like with commodity trading, really, it's all about doing your homework. Okay, you have to do your homework on stocks. It goes without saying. You need to do your research before you can decide what you're going to look to trade in the market. Now, there's a number of different areas. I'm not going to go through all of them. I'm just going to go and do a little bit of them. There's a number of areas you need to really sort of look into and consider before deciding what stock to trade. And here's some examples for you. Now, one of the questions you need to ask is, what does that company actually do? So if you're buying a stock in a company, you have to understand what that company actually does as a business. You know, it's a basic question, but you need to understand what it does. At the same time, you need to ascertain if there's a market or how good that market is for that company's goods and services. Is their market hungry for it? Is the demand for buying smartphones, for example, if you're Samsung or Apple, is it growing? You know, that sort of thing. You also need to understand if there are new products or services on its way, which that company could, which could impact that company's share price. I mean, for example, I said Apple before, let's go back to Apple. Say, for example, Apple's new iPhone, is it, how good is it going to be? Is it going to change the industry? Is it going to, I don't know, is it going to be able to like drive you to work as well as be a telephone, whatever? Of course, I'm joking. So that sort of things, those are the sort of things you need to take into account to consider, like, for example, medical companies, is there a new medicine coming out or new drug they're inventing? Things like that. Those are the sort of things you need to sort of bear in mind when you're sort of looking for key potential shares to trade. Who manages and runs a company? Again, this is something else which you need to bear in mind, because it's often said, of course, that a company is only as good as individuals running it. Now, understanding the management team behind a company, what their skills are, what they can bring to the table, can help you also ascertain if that company has a future. At the same time, with new arrivals, new CEOs, new business development managers, or indeed departures, can all have an impact on the value of that company. Don't believe me? Let's have a look what happened today, for example. As you can see, headline news this morning was that one of the founding members of Instagram has left. Okay, left. He was one of the founding members. Okay, and of course, obviously, Instagram was bought for something, 750 million, I think it was, by Facebook. So on the back of the announcement that one of the founding members was leaving Instagram, Facebook shares absolutely dropped on the back of that news. As you can see, it actually crashed on the open. I mean, it's not unusual, of course, for things like that to happen. But like I say, these are the sort of things you need to bear in mind because, like I say, it can indeed impact the market like it did with that. Now, this is for the US stocks only. And give me a second now, quick. It's better, sorry. I'm kind of thirsty. This is for US stocks only. And this is, sort of reading up on the 10K and the 10Q reports. This is for US stocks. Now, the 10K is an annual report, and the 10Q report is quarterly. Now, both have to be submitted by law to the Securities and Exchange Commission by every single company. Okay? And these reports are an in-depth look at the health and growth or lack of growth of a company. It's a complete, basic balance sheet, everything on that company. Now, you can find these reports, and they're public. They're available for everybody to see on the Securities and Exchange Commission's official website, which is www.sec.gov. So again, if you're interested in US stocks, Microsoft, Apple, Starbucks, whatever, Facebook, you name it, Nike, you can go onto the www.sec.gov and you can look back or look at that 10K or 10Q reports to see if that company is growing. And if indeed it's growing, again, could potentially mean their share price is going to move as well. So again, available for the public to read. So again, so one of the things I would suggest you read up, and when you have an idea, you can do your research on that. Who are the company's competitors? Easy for me to say, James. Who are the company's competitors? Now, this is important because, look, let's face it, it's a dog-eat-dog world, isn't it? And rival companies are forever trying to take business from each other. So it's a good idea, for example, if you're looking at Coca-Cola, it's good to understand Pepsi, because they're the two biggest rivals. If you're looking at, say, Samsung and Apple, for example, for the smartphone market. So again, these are the things you all need to bear in mind. And ideally, you should be aware of a company's market share and, of course, how dominant they are in the marketplace. And at the same time, you should be aware of the industry the company operates in. Again, it's all dependent if the competitors are growing, etc. If the industry is growing or slowing down, again, it's going back to knowing what the company does. It's the same thing. So that's one of the big things for you to actually understand and to know. And the big one, of course, does the company actually make a profit? Because if the company is obviously profitable, the company is going to be sticking around and growing, means that share price in that company is going to likely to go up or move up. So again, does a company make a profit? This, again, very simple, but it's a major driving factor to a company's share price. And again, to engage this, you need to follow or be aware of a company's earnings report, which again is released. Everybody can see that But again, released both quarterly and annually, and you have the earnings season, which can be actually quite hectic for the stock market. So again, it's a good idea to know this and be aware of it, because when the earnings come out, either it can be optimistic or disappoint. It can indeed have an impact on the market. To keep on top of this, understand when's due, etc., I like to use this website called www.seekingalpha.com. Again, it has a list of when the earning reports of certain companies coming up on that day, so you can actually be prepared for it. It's like a financial calendar type thing if you're looking at Forex. Sorry, excuse me. So yeah, that's how you'll keep on top of that. And again, it's something I recommend keeping your finger on. And of course, what is market sentiment? How the market is feeling. If the market is bullish or bearish, these are key factors to consider, because they say if the market is bullish, then investors may be more investing into riskier assets like stocks. So stock market might be supposed to be bullish. If the market is scared or bearish, investors may move their money out of stocks, because obviously money moving out of stocks is going to sell off, and into safe havens like gold. So again, ascertaining if the market is bullish. A prime example, for example, you look at the US stock market at the moment, very, very bullish. You look at the Asia stock market, it's constantly sort of seem to be under pressure, of course, because they're concerned on the trade tariffs. So again, it's ascertaining if the market is bullish or bearish, and overall what the market sentiment is. Now, have a sip of my drink, sorry. Now, I tend to do a lot of technical analysis. So when I do my technical analysis training, I talk about currencies a lot. Okay. And a lot of traders out there or educators out there, they look at currencies or commodities and stuff. So I have a question. Obviously, we got over some of those factors of what you need to research and be aware of when looking at stock CFD trading. But okay, just technical analysis work. And I've done a few examples here for us to potentially look at to see if indeed it does potentially work. Now, moving average crossover. Again, it's an example I just pulled off when I was putting this webinar together yesterday. Okay, so here we have a daily chart. This is Nvidia, I hope I'm saying it correctly. And here's the moving average crossover. Now, everybody knows what the theory of the moving average crossover is. We have the 10, which is the small moving average, and we have the 20. The 10 is blue, and the 20 is that sort of mustard yellow color I've chosen for my chart. Now, the theory is, of course, is that when the 10 or the small moves below the larger, the 20, indicates the market is changing direction and going on a downtrend. And when it moves above the 20, or the small moves above the large, indicates the market's changing and potentially going on the uptrend. So let's have a look, see how we did here with this. So here we go. Okay, the 10 moves above the 20. Indeed, the market starts to move up, or share price moved up on Nvidia, whatever, I'm saying it wrong. It moves below the gold or the mustard. Again, of course, as we can see, the market started to sell off. Again, we moved up above it. The market briefly started to rise before then, obviously getting sort of like a range trade. Then it moved clearly above the 10 moved clearly above the 20. And of course, we then saw an uptrend before then, obviously moving below. And again, we saw, like we said, we saw there the market selling off. So on this occasion, okay, it actually indicated that it was going in that direction. Here's Amazon, again, moving average crossover. Remember, blue is the 10, yellow mustard is the 20, so 10 is the small, 20 is the big. Let's have a look, see how we get on. Yep, the 20 moves above 20. Indeed, the market then started to rise. Then sort of moved above it, touched it slightly, but moved above it. And indeed, the market started to rise, then moved below it at this point, and the market did indeed start to sell it off. So that was Amazon. One more, let's look at Disney. Again, the moving average crossover. Okay, the 10, the blue, which is small, moves above the large, and indeed Disney prices started to move higher, moved above it again at this point, and the market indeed started to move higher, moved below it, So the 10 below the 20, and the market started to sell off. However, at the end, look, the 10 still remained below the 20, and the market started to rise up slightly. So again, it didn't give us a clear signal there. Again, obviously, maybe something had happened at that point. So this is again the problem with moving averages and moving average crossover. Remember, they're lagging, so sometimes they might not take into account certain economic reports or headline news or news flashes, because they can, because it's based on previous data. So here again, it's saying, though it worked, and it did give us a sort of indication of the change of direction, on the last one, really wasn't a very clear signal at all. And indeed, it didn't work on that occasion. Bollinger Bands. Let's look at Bollinger Bands and Coca-Cola. Now, we know the theory. The wider the bands are, the more volatile the market is. The narrower the bands are, the less volatile the market is. The top band can act as a potential resistance, and the bottom band can act as a potential support. So the theory is, if it touches the resistance, the market could start to sell off again. If it touches the support, the market can start buying in again. So let's have a look how it looks then this time. Okay, touches the top band, and indeed the market starts to sell off. Comes around near the bottom band, and indeed it acts as a sort of support, and the market buys in again. Doesn't really do here anything, so again, not a clear signal with us there at all. But on this occasion, this time, it topped about top band, and the market sold off. But here, again, not a clear signal. It was touching the bottom band for several sessions. Nothing was happening. Eventually, the market bought in and it started to rise. So again, not a very clear signal on that at all. Look at Facebook. This was yesterday before the drop of Instagram today. Sorry. So here we go, is Instagram again. Top band, okay, yeah, anti-resistance market slightly sold off. Top band, yes, indeed, the market started to sell off again, acted as a resistance. But this time, no. Massive bands, massive volatility. Obviously, something had happened the next day or the day or broken, which changed everything, and that's why the market moved like that. So again, Bollinger Bands worked up to a certain point, but it didn't or couldn't cope with any breaking news, and clearly there was a sell-off, something happened, maybe earnings, some sort of news, maybe a fine, something like that, which affected the market. So that time, the Bollinger Bands wasn't ready for it. And again, like I say, eventually, it then kicked in and hit the bottom band, and indeed, and then it started to rise. So that time, it worked at that moment. Twitter, here we go again. Top band, yes, indeed acted as a resistance, but not beforehand, by the way, topped the top band lots of times before it actually acted in. But again, on this occasion, no, it didn't. Something obviously broke. They closed the trading session. Some news broke. Something happened, which changed everything. And again, the Bollinger Bands didn't actually take it or actually help us on that. Until obviously later on down the line, it started to act like a resistance. And again, touching the support didn't really, jump off the support. So not giving us a proper clear signal. Of course, I will relate to this point. Obviously the last Facebook and Twitter example, they had big drops or big changes in the next day. Things like that can happen in currencies, of course. Certainly with gaps in the market, you can have that. Certainly on an opening on a Monday if something happens over the weekend. So it can be the same. But like I say, with stocks, like I'm saying, just as this example, these three examples,